Welcome. I'm CORA, Mr. Then's AI assistant. I am a wealth of knowledge, and together with Mr. Then will help you reach new heights.
I'm here to help you understand the different business formation types and tax benefits so you can simply understand when and how to transition or start your business. There are four main types of business structures: sole proprietorship, partnership, corporation, and S-corporation. A limited liability company, LLC, is another option that combines some features of these structures. Each type of business structure has its own advantages and disadvantages in terms of legal protection, taxation, and management. Let's take a look at each one briefly. A sole proprietorship is the simplest and most common form of business. It is owned and operated by one person who is personally liable for all debts and obligations of the business. The income and expenses of the business are reported on the owner's personal tax return as self-employment income. A sole proprietorship is easy to start and has minimal paperwork, but it offers no protection for the owner's personal assets in case of lawsuits or bankruptcy. A partnership is a business owned by two or more people who share the profits and losses of the business. Partnerships can be general or limited, depending on the level of involvement and liability of each partner. Partnerships are taxed as pass-through entities, meaning that the income and expenses of the business are reported on each partner's personal tax return according to their share of ownership. A partnership allows for more flexibility and resources than a sole proprietorship, but it also exposes each partner to personal liability for the debts and obligations of the business. A corporation is a separate legal entity that is owned by shareholders who elect a board of directors to manage the business. Corporations are taxed as separate entities, meaning that they pay corporate income tax on their profits and dividends to their shareholders. Shareholders are not personally liable for the debts and obligations of the corporation, but they have limited control over the management and operations of the business. A corporation can raise capital by issuing stock, but it also has more paperwork, regulations, and costs than other types of business structures. An S-corporation is a special type of corporation that elects to be taxed as a pass-through entity, similar to a partnership. This means that the income and expenses of the business are reported on each shareholder's personal tax return according to their share of ownership. An S-corporation has the same legal protection and capital-raising advantages as a regular corporation, but it also has some limitations, such as the number and type of shareholders it can have. A limited liability company, LLC, is a hybrid form of business that combines some features of a corporation and a partnership. An LLC is owned by members who can choose how to manage and tax the business. An LLC can be taxed as a sole proprietorship, a partnership, a corporation, or an S-corporation, depending on the number and type of members and their preferences. An LLC offers more flexibility and less paperwork than a corporation, but it also provides limited liability protection for its members. As you can see, there are many factors to consider when choosing a business structure for your new or existing business. You should consult with a professional accountant or attorney before making any decisions. If you have any questions or need more information, please contact Mr. Then or visit his website. Thank you for watching this video. I hope you found it helpful and informative. Have a great day.